Assalamualaikum and greeting to ladies and gentlemen. Welcome on our forum, Regulatory Framework, Islamic Banking Law versus Conventional Banking Law. My name is Naalia Hani binti Muhammad Ya Aziz. My metric number is 294606. I'm honored to be a moderator for today's event. Today, we will dive into the intricate regulatory landscape that governs Islamic and conventional banking, focusing on compliance and supervision. We have an exciting lineup of panelists who will share their expertise and insight with us. Our aim is to foster a deeper understanding of this two banking system and the regulatory framework that ensure their stability and integrity. Before we begin, I'd like to warmly welcome our distinguished guests and participants joining us from around the world. Without further ado, let me introduce our panelists for today. Firstly, for panel 1, we have Sir Fauzi. Next, for panel 2, we have Ms. Majidah. And lastly, our third panel, Ms. Aisha. It will be honored if each panelist could kindly introduce themselves. Panel 1, please feel free to begin.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Fauzi bin Alias and my metric number is 294369. I would like to say thank you very much for inviting me to this forum today.
Thank you, Sir Fauzi. Moving on to panel 2, your introduction, please.
Assalamualaikum and hi everyone, my name is Majidah binti Azmi with metric number 292571. Glad to be here, thank you.
Excellent, Ms. Majidah. Finally, panel 3, your introduction, please.
Assalamualaikum and greeting for everyone. My name is Aisha Amira with metric number 294503. I am excited to be here with you today and I hope that you will enjoy this forum together with me. Thank you.
Thank you, Sir Fauzi, Ms. Majidah and Ms. Aisha for your introduction. We are excited to have such distinguished experts with us today. Let's move on to our first session. We'll cover the fundamental principle of Islamic and conventional banking. Our speaker for this session is Sir Fauzi. Could you please start by explaining the core principle of Islamic banking and provide us with an overview of the key practice in a conventional banking?
Thank you Alia as a moderator today for the question. So in our world today, we have so many banks and maybe we cannot differentiate whether bank is Islamic or conventional. So let me explain. Islamic banking operates under Sharia law, which prohibits the charging of interest or riba. Instead of traditional loans with interest, Islamic banks use profit-sharing arrangement like mudharabah, where one party provides the funds and the other manage the investment, sharing profits according to a pre-agreed ratio. For example, if a bank finances a business venture through mudharabah, they share the profit based on the agreed terms, promoting a collaborative and equitable approach to financing. Conversely, conventional banking operates within regulatory frameworks that allow the charging of interest on loans and other financial products. This system focuses on maximizing returns for shareholders through interest-bearing loans, mortgage, and credit cards. For instance, when you take out a mortgage from a conventional bank, you agree to repay the loan with interest over a fixed period, with the bank earning profit from the interest charged on the principal amount. Islamic banking also emphasizes ethical consideration in its investment, avoiding sectors like alcohol, gambling, and unethical business. This aligns with Sharia principles that promote economic justice and fairness. In contrast, conventional banks may invest in a wide range of industries based on financial returns and risk assessment, which may include sectors that some consider unethical or socially harmful. Understanding these differences is crucial because it influences how individuals and business choose their banking partners based on their values and financial needs. Islamic banking offers an alternative for those seeking ethical financial solutions, emphasizing fairness and community welfare. Meanwhile, conventional banking provides a broader array of financial products and services appealing to a wider range of consumer needs, but often at the cost of ethical consideration. In conclusion, both Islamic and conventional banking systems play a vital role in the global financial system, each with its own principle, practices, and implication. By understanding this distinction, we can make informed decisions that align with our values and goals, whether it's for personal finance management, business investment, or ethical consideration in financial dealings. Thank you.
Thank you for your comprehensive presentation. This foundational insight will be crucial as we dive deeper into the regulatory framework. Islamic banking operate under Sharia law, which prohibit interest, riba, and use profit-sharing arrangement like mudharabah. This approach emphasizes ethical investment and economic justice. In contrast, in conventional banking charge interest on loan and focusing on maximizing return through various financial products, sometimes investing in sector that may be considered unethical. In conclusion, both Islamic and conventional banking system has unique principle and practice. Understanding these differences help individuals and businesses choose financial solutions that align with their value and needs. In our next session, we will explore the regulatory body that oversee Islamic and conventional bank. Ms. Majida, can you discuss the role and responsibilities of Sharia Board, accounting and auditing organization for Islamic financial institution and the Islamic Financial Service Board in regulating Islamic bank? Additionally, could you shed light on the role of the central bank, the Basel Committee on Banking Supervision, and the Financial Stability Board in regulating conventional bank?
Certainly, thank you to the moderator for inviting me to share this topic. First of all, Sharia boards are essential in Islamic banking as they ensure all financial products and services adhere to Sharia law. Our responsibilities include reviewing and approving new financial products to ensure they avoid interest, riba, excessive uncertainty in moral, and gambling measures. We also monitor the bank's operations to maintain compliance, provide advisory services on Sharia-related issues and issues fatwas, or Islamic legal rulings on specific transactions. This ensures the bank's activities are aligned with Islamic ethical principles. Next, IOFI plays a pivotal role in setting standards for the Islamic finance industry. We develop and disseminate standards for accounting, auditing, governance, ethics, and Sharia compliance to ensure consistency and transparency. These standards help maintain the integrity of financial reporting and auditing processes within Islamic financial institutions. By aligning with international standards, by adhering to Sharia principles, we enhance stockholder confidence and promote best practice across the industry. Now, let's hear about the IFSB. It's dedicated to promoting the stability and the soundness of the Islamic financial services industry. We issue standards and guiding principles covering risk management, capital adequacy, corporate governance, and transparency. Our goal is to harmonize regulatory and supervisory practices across jurisdictions while facilitates the development of a stable and efficient Islamic financial system. Additionally, we conduct research, provide training, and host forums to disseminate knowledge and promote best practices in Islamic finance regulation and supervision. Let's move to central banks that are fundamental to regulating and supervising conventional banks. We implement monetary policy by managing interest rate and controlling the money supply to achieve macroeconomic goals such as controlling inflation and fostering economic growth. Central banks also oversee the stability of the banking system by setting regulatory requirements such as capital adequacy and liquidity standards, conducting bank examinations, and enforcing compliance with banking laws and regulations. Moreover, we act as lenders of last resort, providing emergency funding to banks in times of financial distress to ensure the stability of the financial system. Now I'm going to explain about the Basel Committee on Banking Supervision. The BCBS is a key global standard setter for prudential regulations of banks. We develop guidelines and standards to enhance the quality of banking supervision worldwide. Our most notable contributions are the Basel Accords, Basel I, II, and III, which set international standards for capital adequacy, stress testing, and market liquidity risk. These standards aim to strengthen the resilience of banks, improve risk management practices, and promote a level playing field across jurisdictions. The BCBS also facilitates cooperation among banking supervisors and fosters the exchange of information to address global banking issues effectively. Last but not least, the FSB is an international body that promotes global financial stability. We monitor the financial system and make recommendations to address vulnerabilities. Our work includes developing frameworks for effective resolution regions for failing financial institutions, improving transparency and oversight of shadow banking, and enhancing the resilience of financial markets and institutions. By coordinating the development of regulatory, supervisory, and other financial sector policies, and collaborating with standard-setting bodies like the BCBS, we aim to prevent financial crises and mitigate their impact when they occur.
Thank you, Ms. Majida. Understanding the regulatory bodies is crucial for appreciating the compliance mechanism in place. It's clear that both Islamic and conventional banking system has robust regulatory framework to ensure stability and integrity. This helps maintaining confidence and promote the healthy functioning of the global financial system. Next, let's move on to next session, where we will compare the regulatory framework and standard of the Islamic and conventional bank. Ms. Ansha, could you explain the profit and loss sharing mechanism and asset backup financing in Islamic banking? Additionally, could you elaborate on the capital adequacy requirement and risk management practice in conventional banking?
Sure. Firstly, I want to thank the moderator for asking. As you all know, Islamic bank operates on principles that differ significantly from conventional law. And at the core of this principle is the prohibitions of riba and the emphasis of risk sharing and ethical investment. Let's explore some of the key regulation frameworks and standards in Islamic banking. First, we have profits and loss sharing mechanism, such as mudharabah and musyarakah. Mudharabah is a partnership where one party provides capital while the others provide expertise and management. Profits are shared according to the pre-argument ratio, but losses are borne solely by the capital provider. For example, in mudharabah agreement, if a bank A provides 1 million in capital to an entrepreneur, the entrepreneur manages a business venture and both parties agree to share the profits at a ratio of 70 and 30 ratio. If the venture earned 5,000 in profits, bank A receives 350,000 and the entrepreneur receives 150,000. If the venture incurred a loss, bank A bears the loss, but the entrepreneur does not earn any profit. Next is musyarakah. Musyarakah involves all party contribution to the capital and sharing profits and loss based on their capital contributions. This encourages a more equitable distributions of risk and reward, aligning with the principle of fairness in Islamic finance. For example, in musyarakah partnership, if there are 3 investors contribute to the capital of a venture with 1,000, 2,000, and 3,000 respectively to start a business, profits and loss are shared according to their capital contributions, meaning the first investor receives 10% of the profits, the second 20%, and the third 30%. Asset-based financing is another fundamental aspect. Murabahah, or cost-plus financing agreements, allows the bank to purchase goods and sell them to customers at a profit margin. Ijarah is a lease agreement where the bank buys a lease out of an asset. Sukuk is often referred to as Islamic bond, represent ownership in a tangible asset or business venture. For example, in Murabahah transaction, Bank B buy a piece of machinery for 50,000 and sell it to the customer for 55,000, allowing the customer to pay in an installment. The profit margin of 5,000 is pre-agreement and transparent. Moreover, in Islamic banks, they must adhere to ethical and social responsibility requirement. Investment should align with Sharia principles, avoiding sectors like alcohol, gambling, speculative, and others prohibitions element. Banks are encouraged to engage in social beneficial activity such as community development and charitable contributions. Now, let's take a look at conventional banking regulation framework. Unlike Islamic banking, conventional banking primarily revolves around interest-based transactions such as risk management and financial products. Capital adequacy requirements are cornerstone of conventional banking regulations as outlined in the Basel Accord. These requirements ensure that banks have sufficient capital to absorb potential losses and continue operating during financial stress. For example, under the Basel III, banks are required to maintain a minimum of Common Equity Tier 1 ratio of 4.5% of risk-weighted assets. These have enhanced the resilience of banks to financial shock. Conventional banks use various financial instruments for risk management, such as derivative, swap, futures, and these instruments help banks hedge against risks related to interest rates, currency, and other market variables. Regulatory requirements for anti-money laundering and consumer protections are also crucial in conventional banking. Banks must implement a robust AML program and comply with activities and protect consumers. That's all from me. Thank you.
Thank you, Ms. Aisha, for that detailed explanation. To recap, Islamic banking use profit and loss sharing mechanism like mudarabah and musyarakah to emphasize risk sharing and ethical investment, asset backup financing through instruments like mudarabah, ijarah, and sukuk aligned with Sharia principle. In contrast, conventional banking use on capital adequacy requirement and risk management practice as outlined in Basel Accords to ensure financial stability and compliance with regulatory standards. In conclusion, understanding the distinct regulatory framework and standard for Islamic and conventional banking is crucial for appreciating how the system operates and maintaining stability. This knowledge helps stakeholders make informed decisions that align with their financial goals and ethical value. For our next session, we focus on compliance and supervision. Ms. Majida, can you discuss how Islamic Bank ensures Sharia compliance and the role of national regulators? Additionally, could you talk about the regulatory compliance and supervisory practice in conventional bank?
Of course, Islamic banks have several mechanisms to ensure Sharia compliance. The most important one is the Sharia Supervisory Board, SSB. This board consists of scholars who are experts in Islamic law and finance. They review and approve all products and services to ensure they align with Sharia principles. The SSB conducts regular audits and reviews of the bank's operations, transactions, and financial statements. They issue fatwas, which are rulings or guidelines on whether specific financial practices are permissible. Additionally, many Islamic banks have internal Sharia compliance departments that work closely with the SSB to monitor day-to-day operations. Next, we move to the role of national regulators. National regulators play a significant role in ensuring Islamic banks adhere to Sharia principles. In many countries with significant Islamic banking sectors, regulators have established specific frameworks and guidelines for Sharia compliance. For example, in Malaysia, the Central Bank Negara Malaysia has a dedicated Sharia Advisory Council that sets standards and resolves disputes regarding Sharia matters in Islamic finance. They provide the regulatory infrastructure that supports Sharia compliance. This includes setting requirements for the establishment and operation of Sharia boards, conducting independent reviews, and sometimes even providing training and certification for Sharia scholars. In contrast, for conventional banks, regulatory compliance and supervision focus primarily on financial stability, consumer protection, and risk management. National regulators like the Federal Reserve in the US or the Financial Conduct Authority in the UK set and enforce rules to ensure banks operate safely and soundly. Conventional banks are subject to regular audits, both internal and external, and must submit detailed reports to regulators. There are also on-site inspections and stress tests to evaluate the bank's ability to withstand economic shocks. Compliance departments within these banks monitor adherence to laws and regulations covering areas like anti-money laundering, capital adequacy, and consumer protection. So we can conclude that Islamic banks focus on ensuring that their operations align with Sharia principles, while conventional banks emphasize financial stability and regulatory compliance. Both require stringent oversight and detailed frameworks to maintain integrity and trust in the financial system.
Thank you, Ms. Majidah. It's evident that both banking systems have rigorous compliance and supervisory mechanism. We will now move into the discussion on the challenges and the opportunities in banking regulation. Please welcome Sir Fauzi. As we move forward, I'd like to pose a few questions for further discussion. What are some of the key challenges in balancing compliance with innovation in financial products? Additionally, what are your thoughts on addressing global regulatory challenges and cross-border banking issues? Can you share your insight on future trends in banking regulation, and do you have any additional thoughts on the opportunities in the current regulatory landscape?
Thank you for the question. Banking regulation, like any set of rules, come with its fair share of challenges and opportunities that affect both banks and the people they serve. On the challenging side, keeping up with rapidly evolving financial technologies can be tough. It often means that regulations struggle to keep pace with new innovations, which can create uncertainty and compliance burdens, especially for smaller banks. However, there's a bright side too. Regulations play a crucial role in ensuring that banks operate responsibly, protecting customers, and maintaining stability in financial markets. When regulations are clear and effective, they foster trust among consumers and investors alike, which is essential for a healthy economy. Moreover, advances in technology are not just a challenge, they also bring opportunity. Innovation like regulatory technology, RegTech, help banks streamline compliance process, making them more efficient and potentially reducing costs for everyone involved. In essence, while navigating the world of banking regulation is not always easy, it is a balancing act that, when done right, can lead to safer, more efficient financial system that benefit everyone from bankers to everyday consumers.
Thank you, Sir Fauzi, for your insightful analysis on balancing compliance with innovation in financial products. Your explanation highlighted the challenges of keeping up with rapidly evolving financial technologies and the crucial role regulation play in the ensuring responsible banking practice. The potential of regulatory technologies to streamline compliance process were particularly enlightened. Additionally, your thought on addressing global regulatory challenges and the importance of coordinated effort among international regulatory bodies were very informative. The future trend in the banking regulation, such as integrating new technologies, enhancing cybersecurity measures, and promoting sustainability, will undoubtedly shape the financial landscape in a significant way. We will now have interactive workshop where we'll analyze, case study, and discuss the best practice in regulatory compliance. Ms. Aisha, could you please guide us through this session?
Certainly, Ms. Alia. I'm also excited to tell you more about this case study and practices in regulatory compliance for both Islamic and conventional banks. This will give us a practical understanding on how different banking systems navigate compliance and supervisory challenges. Let's begin with Islamic Bank. In Saudi Arabia, the Saudi Arabian Monetary Authority (SAMA) use a unified supervisory framework for both Islam and conventional bank. SAMA has a dedicated Sharia department that require banks to submit periodic report on their Sharia compliance. Regular inspections are conducted to ensure adherence to Sharia principle. Enhanced transparency and disclose is a best practice in Saudi Arabia. Islamic bank must disclose Sharia compliance for their financial statement and report regularly to supervisory authority. This promotes transparency and protects shareholder. In Pakistan, the State Bank of Pakistan (SBP) supervises Islamic bank through a separate Islamic department. This department focuses on ensuring strict adherence to Sharia principle while maintaining financial stability. The SBP conducts Sharia compliance audits and apply a tailored Camel's rating system. Sharia audits are a best practice in Pakistan. The SBP audits examine financial products, contracts, and operations to ensure compliance with Islamic law. This practice ensures that Islamic banking operates within the bounds of Sharia principle. Now, let's take a look at conventional bank. In the United States, the Federal Reserve System supervises conventional bank through a comprehensive framework involving regular examinations, capital adequacy assessment, and risk evaluations. This aim is to maintain sound financial practices and regulatory compliance. Risk-based supervision is a best practice in the United States. This approach focuses on areas of greatest risk within a bank, allowing for efficient use of supervisory resources and ensuring robust risk management. In the European Union, the European Central Bank (ECB) and national supervisory authorities jointly oversees conventional bank in the Eurozone under the Single Supervisory Mechanism (SSM). This framework includes regular stress testing, on-site inspections, and continuous monitoring. Stress testing is a best practice in the European Union. Regular stress tests assess banks' resilience to adherence, economic conditions, identifying potential vulnerability, the results from supervisory actions to ensure banks can withstand financial shock. Now that we have an overview of all this case study, let's move on to discussing some of the best practice in regulatory compliance for both systems. For Islamic banking, enhancing transparency and disclosure is encouraged for them. Islamic banks are encouraged to adopt transparency and disclosure requirements based on guidance from the Islamic Financial Service Board (IFSB). These include mandatory disclosure of Sharia compliance in financial statement and regulatory reporting to supervisory authority. Sharia compliance audits are also crucial. Supervisory authorities conduct Sharia compliance audits, particularly in jurisdictions with significant Islamic finance penetrations. These audits ensure that financial products, contracts, and operations comply with Sharia principle. Specialized training for supervisors is another best practice. Training for supervisory staff on Islamic finance principle and Sharia compliance ensure effective oversight of Islamic banks. Technical assistance from organizations like the IFSB and IOIF is also utilized. For conventional bank, risk-based supervision is essential. Conventional banks are subject to risk-based supervisions, focusing on the area of greatest risk within a bank. This approach allows for efficient use of supervisory resources and ensure robust risk management practice. Capital adequacy requirements are also a key practice. Supervisory authority require conventional banks to maintain sufficient capital to absorb potential loss. This is typically implemented through international standards such as Basel III. Stress testing is a final best practice. Regular stress testing assessing banks' resilience to adherence economic conditions, supervisory actions to ensure banks can withstand financial shock. This is all from me. Thank you. You can continue, Ms. Alia.
Thank you very much, Nia Asha, for guiding us through those insightful case study and the best practice in regulatory compliance. It was enlightening to see how both Islamic and conventional banking systems navigate their unique challenges and ensure robust compliance mechanisms. To recap, we explore the following key points. Key point for Islamic banking, we ensure the profit and loss sharing mechanism like mudarabah and musyarakah, as well as asset-backed financing through murabahah, ijarah and sukuk. We discussed best practice such as enhanced transparency and disclosure, Sharia compliant audit, and specialized training for supervisor. Key point for conventional banking, we look at the regulatory framework in the United States and the European Union, emphasizing risk-based supervision, capital adequacy requirement, and stress testing as key practice for ensure financial stability and compliance. We also discuss specific case study from Arab Saudi and Pakistan for Islamic banking and from the United States and European Union for conventional banking, highlighting the best practice like enhancing transparency and stress testing. Thank you again, Ms. Aisha, for guiding us through this important concept. As we conclude today's forum, I'd like to summarize some key takeaways. We have explored the fundamental differences and the similarities between Islamic and conventional banking, delved into the roles of various regulatory bodies, and examined the framework that ensure compliance and supervision. Our discussion on challenges and opportunities have been highlighted the dynamic nature of banking regulation. Thank you for all our panelists for your insightful contribution, and to all our participants for your active engagement. We hope this forum has been both informative and engaging. Please stay connected with us for future events. Have a great day. This concludes our forum on regulatory framework, Islamic banking law versus conventional banking law. Thank you for joining us.